So you've decided to buy a house. Congratulations on embarking on one of life's most exciting, rewarding, and honestly, occasionally hair-pulling adventures. You've probably heard a lot of intimidating terms thrown around, like amortization, PMI, adjustable rate mortgage. But there's one word that seems to pop up everywhere, shrouded in a bit of mystery: escrow. What is this magical, mythical beast? Is it a dragon guarding a treasure chest? Close, but not quite. Think of escrow as a neutral, super responsible friend who holds onto everyone's money and important documents during a real estate deal. This friend makes sure nobody runs off with the cash or the house keys until every single promise in the contract has been fulfilled. It's the ultimate transaction referee, ensuring a fair game for both you, the buyer, and the seller. Essentially, escrow is a financial arrangement where a third party, the escrow agent, steps in to temporarily hold assets on behalf of the two other parties who are in the process of completing a transaction. For home buyers, this means your earnest money, down payment, other funds are kept in a secure, separate account. The seller doesn't get a dime until they've held up their end of the bargain, like making agreed-upon repairs proving they actually own the house free and clear. The escrow journey officially begins the moment your offer on a home is accepted. Cue the confetti and celebratory pizza. After you've done your happy dance, you and the seller will sign a purchase agreement. This document is the master blueprint for the entire transaction: the sale price, the closing date, all the conditions, contingencies that need to be met. Once that contract is signed, it's time to open escrow. Your agent or the seller's agent sends a copy to a neutral third party, like a title company or escrow officer. That act officially kicks things off and establishes your escrow account. Your first major task in this stage is to deposit your earnest money. Think of this as your "I'm serious about buying this house" deposit. It's typically 1 to 2% of the total purchase price. It shows the seller you have skin in the game. This money doesn't go directly to the seller. Oh no, you'll write a check or wire the funds directly to the escrow company. The escrow company deposits it into that secure escrow account we talked about. This money is safe and sound and will be applied toward your down payment and closing costs when the deal closes. It's your first financial step toward homeownership, securely held by your new best friend, the escrow agent. Once the escrow account is open and your earnest money is safely tucked away, the escrow officer will introduce themselves to all parties involved. They'll provide everyone with an escrow number and a preliminary timeline of key dates and deadlines. This is where you'll want to pay close attention. Your escrow officer is the keeper of this calendar, but it's your responsibility, with the help of your agent, to make sure you're hitting all your marks on time. Don't be afraid to ask questions. Your escrow team is there to clarify the process. You'll receive a mountain of opening paperwork from the escrow company asking you to confirm your personal information. With your escrow account officially open, it's time for the investigation to begin. Your escrow team and professionals put on their detective hats. First order: title search. They dive into public records to verify the seller they're looking for. Clouds on the title: outstanding mortgages, unpaid property taxes, liens from contractors who weren't paid, legal claims from a long-lost heir. You don't want to inherit someone else's financial baggage. The result is a preliminary title report. The report lists everything the title company found: liens, easements, other encumbrances. Don't panic. Most reports show something like a mortgage the seller will pay off at closing. Your escrow officer and real estate agent will review the report with you. That's a huge benefit of escrow. It helps ensure you receive a clear title. While the title company plays detective with the property's history, you play detective with the property's physical condition. Hire a professional inspector to go through the house with a fine-toothed comb, checking the roof, checking the foundation, checking the plumbing, checking the electrical system. They'll provide a detailed report with pictures and recommendations. This is your chance to learn about hidden problems: leaky water heater, faulty wiring, signs of foundation issues. You should absolutely attend the inspection if you can. It's an opportunity to learn the ins and outs of your potential new home. Based on the inspection report, you may have some decisions to make. Once you're satisfied with the property's condition and the title is on its way to being cleared, you're ready to move on to the next big hurdle: financing. Now we get to the part of the process that's all about the money, specifically the giant pile of it you need to borrow. Unless you're paying in all cash, and if you are, can we be friends? You'll be working closely with your mortgage lender during the escrow period. You should have already been pre-approved for a loan before you even made an offer. Now it's time for the official underwriting process. Your lender will ask for a seemingly endless stream of financial documents, bank statements, pay stubs, tax returns, letters explaining that one time you deposited $50 from your grandma. Provide these documents quickly and completely. Any delay here can directly delay your closing. A crucial part of the lender's process is the home appraisal. The bank won't just take your word for it. They hire an independent licensed appraiser to assess fair market value. The appraiser will visit the home, measure it, take photos, and compare it to similar properties, comps. Their goal? Ensure the property is sufficient collateral. If the appraisal is at or above the purchase price, everyone breathes a sigh of relief. This protects both you and the lender. But if the appraisal comes in low, say you agreed to pay $500,000, but the appraiser values it at $480,000. The lender will usually loan based only on the appraised value, leaving a $20,000 gap. Options: renegotiate the sales price with the seller, come up with the extra cash yourself, dispute the appraisal, or some combination of these. Once appraisal issues are resolved and underwriters approve, you'll get a clear to close. That means your financing is secured. The lender coordinates with escrow to prepare final closing documents. The finish line is near, and your escrow officer is making sure all the financial puzzle pieces fit together perfectly. Okay, so think of your purchase agreement as a to-do list on steroids. This list is filled with contingencies. Contingencies are just fancy legal terms for conditions that must be met for the sale to go through. The escrow process is basically a long, coordinated dance, what I like to call the contingency conga line. Each time a condition is met, another one steps up. The most common contingencies are for the inspection, appraisal, loan approval. For example, your inspection contingency gives you a set period, often 7 to 15 days, to conduct inspections and either approve the condition of the home or negotiate repairs. Once you're satisfied, you'll sign a form to remove that contingency, signaling to everyone that you're moving forward. Your escrow officer plays a key role in tracking these deadlines. They don't enforce them, but they keep everyone informed about what needs to be done and by when. It's up to you, your agent, and the seller to meet these dates. For instance, if you agreed with the seller that they would replace the rickety old fence before closing, that becomes a condition of the sale. The escrow officer will need confirmation, often in the form of a paid invoice or a final walkthrough verification, that the work has been completed as agreed upon. Until that condition is met and the contingency is removed, the deal can't close. This ensures that promises made during negotiations are promises kept. The process of removing contingencies is a formal one. You don't just call up your agent and say, "Yeah, the inspection was fine." This is a legally significant step. This step-by-step removal process is what moves the transaction safely and methodically toward the closing table. You've navigated the inspections. Your loan is approved. All contingencies have been removed. You're in the home stretch. This final phase of escrow is all about double-checking the details and preparing for the big day. One of the most important documents you'll receive at this stage is the closing disclosure, or CD. Your lender is legally required to provide this to you at least 3 business days before your scheduled closing. This 5-page document is your financial holy grail. It itemizes all the final numbers for your loan: interest rate, monthly payment, lender fees, title insurance premiums, escrow fees, prepaid property taxes. Your job is to review the closing disclosure with a microscope. Compare it to the loan estimate you received when you first applied for your mortgage. If you see any major discrepancies or fees you don't understand, now is the time to ask questions. That 3-day review period is designed specifically to give you time to spot errors and get them corrected before you're sitting at the signing table. Once you've confirmed everything is accurate, you can move on to the next exciting step, the final walkthrough. The final walkthrough is exactly what it sounds like. Usually conducted 24 to 48 hours before closing, this is your last chance to visit the property. Make sure it's in the same condition as when you agreed to buy it. You'll also verify that any contractually obligated repairs have been completed satisfactorily. Turn on all the lights, run the faucets, flush the toilets, check the appliances. If you discover any new significant problems, flag them to your agent immediately. The escrow process gives you leverage here, as the seller's funds can be held until the issue is resolved. The stage is set for a flawless finale. The day has finally arrived, closing day. This is the culmination of weeks, sometimes months, of hard work, patience, and a whole lot of paperwork. Depending on where you live, closing can look a little different. In some states, the buyer and seller meet at a table with the escrow officer or a closing attorney to sign documents together. In other states, like California, it's more common for the buyer and seller to sign separately, sometimes even on different days. Either way, get ready for a hand workout, because you're about to sign your name more times than you ever have in your life. You'll be signing the mortgage note, your promise to repay the loan, the deed of trust, which secures the property as collateral, and dozens of other disclosures and legal forms. Don't be intimidated by the mountain of paper. Your escrow officer or closing agent will walk you through each document, explaining what it is and where to sign. This is not the time to be shy. If you don't understand something, ask. You are signing legally binding contracts for the largest purchase of your life, so you have every right to be 100% clear on what you're agreeing to. Bring your photo ID, a certified or cashier's check for any remaining costs, though a wire transfer is more common and often required, and proof of homeowner's insurance, and maybe a bottle of water, and a comfortable pen. You'll be there for about an hour, signing, initialing, and dreaming of where you'll put your sofa. Once all the documents are signed by both you and the seller, the escrow officer's final act begins. They can't just hand over the keys yet. First, they need to get confirmation from the lender that the loan funds have been wired into the escrow account. Once the recorder's office confirms that the deed has been recorded, you are, without a doubt, the official owner of the home. At this point, your real estate agent will get the green light to hand over the keys. Congratulations, you did it. Everyone wants their escrow to close on time, or even early if possible. While much of the timeline is fixed, there are absolutely things you can do as a buyer to keep the train moving and avoid being the reason for delays. The number one rule? Be ridiculously responsive. When your lender asks you for a document or a signature, treat it like a hot potato. Get it back to them the same day if you can. Lenders in particular work on a tight schedule. Waiting for your last 2 pay stubs can genuinely hold up the entire loan underwriting process, creating a domino effect of delays down the line. Second, get your financial ducks in a row before you even open escrow. This means having your down payment liquid and accessible. This means having your estimated closing costs liquid and accessible. Don't have it tied up in stocks you need to sell. Don't have it hidden in a mattress at your cousin's house. Lenders need to source your funds. They need to see a clean paper trail of where the money came from. A large, mysterious cash deposit a week before closing will raise red flags and trigger a fraud alert, grinding your transaction to a halt. Another pro tip is to schedule your inspections immediately. Good inspectors are often booked a week or more in advance, and your inspection contingency period is ticking. Letting your 10-day inspection period almost expire before you even call an inspector is a rookie mistake that puts unnecessary pressure on everyone. Be proactive, not reactive. Finally, stay in close communication with your team. By being organized, responsive, and communicative, you become an asset to the process, helping ensure your journey to homeownership is as smooth and speedy as possible. After all the paperwork, the waiting, and the endless requests for documents, you might wonder if this whole escrow thing is really worth the trouble. The answer is an emphatic, unequivocal yes. Escrow is the unsung hero of the real estate world, the silent guardian that makes sure your dream of homeownership doesn't turn into a financial nightmare. Its greatest benefit is protection. As a buyer, you are handing over the largest sum of money you've likely ever spent. Escrow ensures that money is held safely and isn't released to the seller until they have met every single condition of the contract, proving they have a clear title, completing agreed-upon repairs. It eliminates the terrifying what-if scenarios. For sellers, escrow provides the same peace of mind. They can confidently take their home off the market, pack their belongings, and sign over the deed, knowing that the buyer's funds are verified, secured, and ready to be transferred the moment the deal is done. By creating a fair and balanced playing field, Escrow builds the trust necessary for two strangers to engage in such a high-stakes transaction. It replaces anxiety and suspicion with structure and security, which is absolutely priceless when you're dealing with your life savings. Moreover, the escrow process ensures that the legal transfer of ownership is handled correctly. Your escrow or title company doesn't just move money around. They are experts in property law. This guarantees that when you get your keys, you are the true, undisputed owner of the property, free and clear of past debts or claims. Without this professional oversight, you could unknowingly buy a house with a massive tax lien or an unresolved ownership dispute. So, as you step over the threshold of your new home for the first time, take a moment to appreciate the complex, highly regulated, and incredibly important process that got you there. Welcome home.